Russia may have sidestepped the latest round of Liberation Day tariffs, but its economy remains dangerously exposed for one simple reason: oil. This sector powers the Kremlin's economy while also exposing its Achilles heel. Oil and gas account for roughly a third of Russia's federal revenue, making fluctuations in the global oil market a matter of national consequence. Prices have fallen sharply this month amid renewed fears of a recession driven by trade tensions. Russia's Urals crude now trades under $55 per barrel, far below the $70 benchmark set in the national budget. Should prices remain at these levels, analysts warn, Russia could suffer a hard landing, with the budget deficit projected to nearly double this year. The timing couldn't be worse for Moscow. Even before oil's plunge, Russia's economy had started to slow. Now, as the Kremlin navigates ceasefire talks with the U.S. over Ukraine, its economic fragility could undercut its negotiating position. Moscow has dragged its feet at the table, betting its battlefield momentum will earn it leverage, but that bet is growing riskier. Current prices aren't yet enough to force President Vladimir Putin's hand, but further declines could shift his calculations. Analysts suggest the Kremlin will soon face difficult choices as falling oil revenues collide with soaring military demands. If oil stays at these levels, the pressure will build, said Alina Rybakova of the Peterson Institute for International Economics. They're already feeling it, and if this continues, it's a classic guns versus butter dilemma. Even with sanctions isolating Moscow from many global markets, the effects of Washington's trade policies are still being felt. JP Morgan analysts wrote this week that the U.S.-driven economic tsunami is bound to reach Russia eventually. Energy wealth has long been central to Putin's grip on power. A collapse in oil prices helped bring down the Soviet Union. A rebound in 1999 helped launch Putin's rise. It's no wonder the Kremlin sees low oil prices not just as an economic threat, but a security risk. The oil industry's importance goes well beyond government accounts. Economists point to a multiplier effect. Booming oil lifts steel, construction, transport, and entire communities. A sustained contraction could ripple through Russia's industrial heartland. Sergei Vakulenko, a former Russian energy executive, estimates Russia loses $25 billion annually for every $10 drop in oil prices. It hits the budget and deprives the whole economy of liquidity, he said. Nonetheless, experts caution that only a sustained slump would seriously impact the Kremlin's war strategy. Russia continues to procure weapons from North Korea and produce much of its own war material. Meanwhile, China's economic support has helped stabilize the situation. The Trump administration understood the leverage of oil. Early on, officials signaled that expanding American and Saudi oil output could be a tool to pressure Moscow. Keith Kellogg, Trump's envoy to Ukraine, even floated a $45 per barrel threshold as a potential game changer. Russia was conspicuously absent from Trump's global tariff list. The administration reasoned that sanctions had already shrunk U.S.-Russia trade to a negligible level. To be fair, Moscow has weathered worse oil crashes, including during the 2008 crisis and the pandemic. It can still tap local banks and slash non-military spending. But that would undercut the Kremlin's wartime pledge to shield civilians from hardship. For 3 years, the regime has cushioned citizens from war's costs with pay raises and job programs. A serious downturn could erode that fragile social pact. Officials are aware of the danger a global trade war lowers demand for our energy, said central bank chief Elvira Nabiullina. There are real risks here. The Kremlin insists it's doing everything possible to cushion the blow. Markets remain jittery amid rising U.S. supply and weakening Chinese demand. Goldman Sachs recently cut its Brent forecast to $63 this year and just $58 by 2026. With Russia's Urals selling at a steep discount, its crude could soon fall below $50. Other major Russian exports like coal and metals are also in decline. Renaissance Capital warned clients this month that continued low oil prices would raise the odds of a hard landing. The bank projects near zero GDP growth if Urals averages $50. That would be a harsh reversal. Military spending had propped up Russia's economy, helping it post 4% annual growth in both 2023 and 2024 despite sanctions. But the war boom came at a cost. Inflation spiraled, forcing the central bank to jack up interest rates to 21%, while labor shortages worsened as men were drafted or fled. By February, year-over-year GDP growth had slowed to 0.8% from 3% in January. Russia has run deficits throughout the war and depleted most of its rainy day national wealth fund. Officials now blame global markets for economic pain, perhaps hoping to deflect public anger. Falling oil may lower living standards, said Vakulenko, but if people see it as a global issue, they're less likely to blame the Kremlin.